A decade from now, some people will look back at this period and speak about it the way earlier. Generations spoke about the rare years when the world quietly changed shape before the crowd understood what was happening. They will say the signs were there. They will say the concentration was visible. They will say the technologies were obvious in hindsight. They will say the demographic drag was already forming. They will say the easy money world was already fading. They will say the disbelief was so thick that most people mistook the opportunity for danger, and they will be right. What interests me is not whether the signs will look obvious later. They usually do. What interests me is whether a person can see enough of them now to position capital before certainty arrives and turns extraordinary upside into ordinary returns. That is the real challenge. I have spent most of my life watching the public misunderstand timing. They think the best opportunities arrive when everything already makes sense. That is not how it works. The best opportunities often arrive when the arithmetic is visible, but the emotional permission is missing. The businesses are there, the curves are there, the spending is there, the infrastructure is being built, the leaders are emerging, but the average person still feels cautious, unconvinced, or vaguely offended by how expensive the future already looks. That emotional gap is where a great deal of wealth gets made, not because the future is risk-free, because the future is still underowned. I want to begin with a confession. When I was younger, I believed the great fortunes were mostly built by discovering hidden things. A secret company, a secret formula, a secret edge so subtle that only a few clever minds could possibly notice it. Age changed that view. The greatest fortunes are often built not by finding what is hidden, but by correctly valuing what is already in plain sight, while the crowd is still emotionally late. The market does not always conceal the opportunity. Sometimes it shouts the opportunity, and people still fail to act because the opportunity does not yet feel comfortable enough to deserve a serious allocation. That may be what is happening. Now, I do not mean that every asset is cheap. I do not mean that risk disappeared. I do not mean that the market will move in a straight line. I mean something more precise. I believe we may be standing inside one of those rare windows where several powerful forces cluster at once. And when these forces cluster, a patient investor can do far better than he will likely be able to do later when the same themes are mature, crowded, and fully priced. The public loves the language of certainty. I do not. Certainty usually shows up after the largest money has already been made. When certainty arrives, the multiple is fatter, the room for error is smaller, and the people entering then are usually paying for comfort with reduced upside. That is why I always ask a more useful question: where are we in the curve? That question has made me more money than confidence ever did. Now let me tell you what I think is happening. The first force is technological acceleration. I do not use the word lightly. Every generation likes to flatter itself by claiming it stands at the center of a great transformation. Usually most of the claims are exaggerated, but once in a while the claims are not exaggerated enough. That is when the real fortunes appear. A handful of technological shifts are moving from experiment to economic dominance at nearly the same time. Artificial intelligence is no longer a toy for researchers and enthusiasts. It is becoming embedded in cost structures, productivity, software, customer service, logistics, cloud infrastructure, code generation, data analysis, and decision-making across industries. Automation is doing what automation always does when it becomes real. It is removing labor from some functions, multiplying output in others, and redistributing margins toward the firms that adopt it early and intelligently. At the same time, the energy system is being rebuilt. That phrase does not get the respect it deserves. A grid rebuild is not a fashionable slogan. It is real concrete copper transmission, power demand, storage, and capital expenditure spreading through the economy like a second layer beneath everything else. Then you have biotech and longevity, where the market is still uneven, often speculative and sometimes ridiculous. But the broader direction is unmistakable. The combination of computing power, data, and biological science is beginning to produce outcomes that were not economically feasible in earlier periods. You also have defense, space, and cybersecurity becoming more central than most of the developed world had grown used to assuming. That is not a happy observation. It is simply an honest one. The world has become more dangerous, and dangerous worlds spend heavily on protection, infrastructure, intelligence, redundancy, and digital resilience. Now, notice what happens when several curves like these move at once. The early beneficiaries do not spread equally across the market. They cluster, the public sees that clustering, and often becomes confused. It says the market is narrow. It says the gains are unfairly concentrated. It says the index is unhealthy because a small group of giants seems to be doing most of the lifting. All of that may contain some truth, but hidden inside the complaint is the actual opportunity. When a new economic regime is forming, the earliest gains are almost never broad and democratic. They are concentrated in the firms with the right capital position, the right infrastructure, the right supply chain, the right intellectual property, and the right leadership. That is not distortion. That is how new eras usually announce themselves. The world of investing does not reward the crowd equally for noticing a new curve. It rewards the people who own the enabling businesses early enough and heavily enough that the eventual normalization of the theme still leaves them far ahead. I think often about how people talk about giant winners after the fact. They say a company like NVIDIA was obvious. Of course, it looks obvious after the move. The giant winners of a new cycle always look obvious after the market has already moved through the disbelief phase and into the acceptance phase. The real money, however, was made when the technology still felt too specialized, too early, too concentrated, or too strange for the average portfolio manager to overweight with conviction. That is what I mean by curve position. Once adoption becomes mature, the market stops paying you as generously for being right. The business may still be excellent. The returns simply compress because the future is no longer available at early stage prices. That is why I say the biggest gains happen before certainty, not after. The second force matters just as much, and it is one that many people see but misinterpret. Market returns are becoming increasingly concentrated in a small set of leaders. This makes some investors nervous. It should make them thoughtful. There is a difference. I do not like blind concentration in a portfolio. I also do not confuse concentration in outcomes with irrationality. A very large share of long-term market gains has often come from a relatively small number of extraordinary companies. That is not new. What may be new is the scale and speed with which market leadership has clustered in the present environment. The largest firms now represent a far greater share of market value than many investors are emotionally comfortable with. That discomfort produces two different mistakes. The first mistake is to dismiss the leaders simply because they have become large. The second mistake is to believe that because the leaders are large, the rest of the opportunity must be gone. Both mistakes can be expensive. A concentrated market can mean excess. It can also mean that the economy is being rerouted through a small number of infrastructure, like giants, while secondary winners have not yet been fully re-rated. That is where the thoughtful investor gets to work. He does not merely ask whether concentration is high. He asks what concentration is revealing. If a handful of firms are commanding enormous market value, it may be because they sit at the center of artificial intelligence, cloud spending, compute demand, digital advertising leverage, data center build-out, operating system power, or the semiconductor chain that makes the rest possible. That deserves analysis, not automatic rejection. A concentrated market also means something else. Broad returns may become less evenly distributed over time. The old decades, where many sectors floated higher together under generous monetary conditions, may give way to a period where the majority of outperformance comes from a narrower group of real winners, while large parts of the market move more slowly. This is why many ordinary investors feel confused. They own the whole market and still sense that the real action is happening somewhere more specific. Their intuition is not entirely wrong. The broad market remains an intelligent foundation. I would never tell a sensible person to skip broad ownership if the goal is long-term wealth. But broad ownership alone may not fully express the asymmetry created when new curves are concentrated in a smaller set of leaders. That is why layered exposure matters. I will return to that. The third force is demographics, and almost nobody loves this one because it is slow, cold, and difficult to dramatize. Markets benefited for many years from a very forgiving background, growing workforces, large consumer cohorts moving through prime spending years, globalization expanding efficiency, lower dependency ratios, a world in which the economic engine had age structure working with it more often than against it. That world is changing. Populations are aging. Labor force growth is slower. Dependency ratios are moving in the wrong direction. Large developed economies are going to spend more energy supporting older populations and may have less natural growth support than they enjoyed in prior decades. That does not mean markets must crash. I am not arguing for apocalypse. I am arguing for compression. Broad economic tailwinds may be weaker for a long time. And when broad tailwinds are weaker, outsized gains usually become more dependent on the specific companies, sectors, and technologies still capable of growing well above the background rate. This is another reason the present moment may matter so much. If the economy ahead becomes structurally slower in a demographic sense, then the firms positioned on the right side of productivity, automation, compute, healthcare innovation, digital infrastructure, and security spending may command a disproportionate share of the available upside. In an aging world, broad prosperity may be harder to generate and more unevenly distributed. That does not kill opportunity. It concentrates it. That is the key. You must keep seeing this pattern. Technological curves cluster, market leadership narrows. Demographic drag rises. The number of broad, easy winners may shrink. When all of this happens together, the investor who insists on waiting until the winners feel universally safe is often waiting for a re-rating that will already have happened. That is how decades of ordinary returns get accepted in exchange for the emotional comfort of late entry. The fourth force is monetary, and here the public memory is still contaminated by a long stretch of easy money. People became spoiled by that environment. Cheap money has a way of flattering everyone. It flatters management teams. It flatters mediocre businesses. It flatters private equity. It flatters public equity. It flatters real estate. It flatters people who borrow. It flatters people who confuse rising multiples with superior intelligence. The easy money era rewarded ownership almost indiscriminately for long stretches because falling rates and abundant liquidity kept widening valuation support under a very large share of assets. A generation of investors grew used to that kindness. Now they are entering a different regime. Could rates come down at times? Of course, could a new policy mix produce bursts of easing and renewed market enthusiasm? Absolutely. But the structural lesson remains. The zero-rate world is no longer the reliable background assumption it once was. Future returns are less likely to come from endless multiple expansion and more likely to come from actual earnings growth. Pricing power, margin durability, and business quality. That is a much more demanding environment. It is also, in a strange way, a better one for serious capital. When money is free, people become sloppy. When money has a cost, the distinction between a good business and a merely fashionable business becomes clearer. That is another reason I think this window matters. We may still be in the stage where several giant growth themes are early enough to generate real upside, but late enough that revenue, infrastructure spending, and adoption are no longer imaginary. At the same time, the broader environment is becoming less forgiving, which means later years may reward a much smaller set of true winners, while broad valuation uplift becomes harder to rely on. That is a highly unusual combination. It favors early positioning in the businesses and funds tied to the real engines of the next cycle before the full crowd arrives and before the market settles into a narrower, more mature, less generous rhythm. Now we come to the fifth force, and this one is the most human. Sentiment still lags. Reality, disbelief still lingers. That is the ingredient almost every great wealth window needs. When the public is fully convinced, the easiest money is gone. When the media is celebratory, institutions are already heavy. Retail participation is euphoric. And every dinner conversation sounds like a late cycle advertisement. The game has changed. The extraordinary asymmetry usually lives earlier when the evidence is mounting, but the average person is still cautious, traumatized, skeptical, or waiting for perfect clarity. Clarity is expensive. It arrives after the market has already repriced. I have seen this in many forms. A wonderful business reports strong numbers again and again, but the public still says it feels too risky. A transformative technology begins changing real budgets, but the public still treats it like an overhyped theme. A sector becomes strategically unavoidable, but capital still hesitates because the headlines are noisy and the memory of the last correction is too fresh. That hesitation is what creates the spread between present price and future obviousness. Now, I want to be careful with the phrase last big wealth opportunity for a decade or longer. I do not use language like that lightly. There will always be opportunities. Markets do not run out of them forever. But windows change character. There are periods when public markets still offer outsized upside to patient individuals who can own the right exposures before the larger institutions fully dominate the theme, before valuation saturation flattens the reward, and before the economic background becomes slower and more predictable. Then there are later periods where the same assets are still respectable, but the explosive asymmetry has already been converted into mature compounding. Both can be good. They are not equally good. That is what I think people are sensing now, not the end of markets, a narrowing of the truly lopsided phase. That is why I would not spend this period asking only whether the market looks safe. I would ask whether the future engines are already visible enough that waiting for emotional comfort may prove more expensive than accepting near-term volatility. That is a very different question, and it is the question that serious money tends to ask. Now let me tell you how I would think about implementing this view, because a big thesis without a sound vehicle is only intellectual decoration. If a person believes the next 5 to 10 years may offer unusually concentrated upside in a handful of themes, he must still avoid two stupid behaviors. The first is pretending he can pick every single winning company. The second is abandoning broad market discipline entirely in the name of thematic excitement. Both mistakes are common. A sound approach usually begins with a broad base. I would never skip that. The broad market is not old-fashioned. It is the central ownership engine, a total U.S. market fund, an S&P 500 fund, or even a total world market fund if the investor wants that architecture remains the kind of foundation I respect because it lets civilization, productivity, business formation, and long-run profit creation work on your behalf without requiring heroic stock selection. That should exist in almost every serious long-term portfolio. But once the base exists, the question becomes whether the present environment deserves a more focused layer on top of it. I think it may if I wanted broad-based growth exposure that still captured the giants, most directly tied to artificial intelligence, software dominance, cloud infrastructure, and the innovation spine of the current U.S. market. I would naturally think about the NASDAQ 100 through QQQ or QQM. I prefer QQM. If the lower cost structure matters and liquidity is sufficient for the investor at scale. But the broad idea is the same. This is not a pure AI ETF. That is part of its strength. It captures large, innovative firms that sit across the most important digital and technological currents of the present cycle. You get exposure not only to the obvious AI beneficiaries, but to the operating systems, cloud platforms, digital ecosystems, advertising machines, and large-scale compute demand generators that make the entire regime more profitable. That matters because revolutions rarely enrich only the most obvious flag. Bearer, they enrich the infrastructure, the picks and shovels, the dominant distributors, and the firms that can use the new capability across huge installed bases. QQQ or QQM is a sensible way to express that broad growth thesis without pretending you can identify every individual champion correctly. But let us say a person wants the thesis more concentrated around AI and future tech specifically, rather than broad NASDAQ leadership. Then I would look toward something like ARTY, the iShares Future AI Tech ETF. Now, one must be mature here. A newer thematic fund is never the same thing as a fully seasoned broad market core. Its role should be understood, its volatility should be expected, its holdings should be respected, but not worshipped. Still, the logic is clear. If you believe AI is not merely a software headline, but a broad economic platform touching semiconductors, cloud infrastructure services, and enabling technologies across markets, then a fund like ARTY provides a way to express that belief without making one gigantic single stock bet. That can be useful. The investor is not only saying AI matters, he is saying the supporting ecosystem matters. And it does the final layer. If the investor wants the most specialized exposure of the three is semiconductors, that leads naturally to SMH. I have no objection to specialization when the role is explicit. Semiconductors are not a side note in this cycle. They are one of the essential choke points. No large-scale AI deployment exists without hardware. No data center build-out exists without chips. No compute expansion happens without a chain of businesses providing tools, fabrication, design, and manufacturing capacity. That is why a semiconductor ETF can be such a powerful expression of conviction. It is also why it can be volatile and should not become the whole religion of a portfolio. When you own something specialized, you are accepting that the reward can be very large and the path can still be emotionally violent. That is not a flaw. It is part of the contract. If I were building this out in practical terms, I would think in layers, broad market first. That is the foundation. Then a broad growth and innovation sleeve through something like QQQM. Then for those who want more direct thematic exposure, a smaller allocation to an AI-oriented ETF such as ARTY. Then, for those with the strongest appetite for specialization, a still smaller semiconductor sleeve through SMH that is an adult structure. It respects the thesis without surrendering to it emotionally. It lets a person participate in the concentrated upside while still owning the larger engine of the market. This is important, because one of the dumbest things investors do in exciting periods is to confuse a strong theme with permission to abandon the base. I do not like abandoning the base. A base gives you staying power. A base keeps the portfolio from becoming a single statement about one narrative, and staying power matters because even the best long-term theme can become nearly unbearable in the wrong 12-month stretch. Now, if someone asked me why not just buy the total market and be done with it, I would say that is still an intelligent path. Very intelligent, a broad market fund remains one of the best wealth building tools ever created for ordinary people. But I would also say this. There are moments when the broad market is being driven disproportionately by a smaller group of transformative winners. And if you understand that and can handle the volatility, an intelligent satellite allocation to those drivers can materially improve the long-term outcome. Not because the broad market became bad, because the leaders may still be under-owned relative to the scale of the change they are monetizing. That is the opportunity. Now let me make the argument even more personal. I have lived long enough to know that most people will not become rich because they discovered a secret. They will become rich because they stopped asking the market to make them feel safe before they acted. That is the real threshold. The crowd wants clarity. The patient owner wants asymmetry. The crowd wants reassurance. The patient owner wants the right exposure before reassurance gets priced in. The crowd wants to buy after the narrative sounds settled. The patient owner understands that by then the easiest decade of gains may already belong to someone else. This is why disbelief is so valuable. Disbelief keeps prices from running too far too early. It keeps participation narrower. It gives patient people room. If everyone agreed right now that these technologies, these leaders, these infrastructures, and these chains were the obvious path to extraordinary wealth, the opportunity would be much less interesting. The fact that large numbers of people still hesitate, still wait, still complain about concentration without asking what it means, still worry about headlines while ignoring curve position is exactly what makes the window feel real to me. This does not mean blindly buying any stock with an AI label. That is childish. It means distinguishing between narrative and infrastructure, between speculative costume and actual economic leverage. The money is rarely made in slogans. It is made in the businesses that are actually supplying the picks, shovels, compute, network systems, and recurring cash flow that power the new regime. That is why I like the ETF approach as an expression of this thesis. Not because it is dramatic, because it is honest. Most people are not going to select every individual winner correctly. A layered ETF structure can still place them on the right side of the largest currents without requiring personal brilliance at the level of stock picking. That is a huge advantage if used well. There is another reason I think this period matters so much. The next decade may not look like the last in terms of ease. If demographic drag deepens, if money remains more expensive than investors grew used to, if broader economic growth is slower, and if leadership remains concentrated, then the market ahead may become more selective and more professionalized. The easy era of broad uplift may not be the dominant story. That does not mean returns disappear. It means the outsized returns may be captured more by those who positioned early in the right areas and less by those who waited to see who had already won. That is a very important distinction. The public often imagines wealth as a late reward. Much of real wealth is an early reward collected by those who were willing to feel somewhat uncomfortable while the facts were strong, but the emotions were unresolved. This is why I keep returning to the same phrase, before certainty, not after. That is where the spread lives. Now I want to say something about temperament, because even a correct thesis becomes useless in the hands of the wrong temperament. If you build this kind of portfolio and then check it constantly, compare it to everyone else every week, panic during drawdowns, or keep rearranging it every time the market rotates for 3 months, you will probably destroy the very asymmetry you were trying to capture. That is why I always insist that the emotional design of a portfolio matters as much as the intellectual design. A broad market core helps. It steadies the structure. A deliberate allocation size helps. If the thematic sleeve is too large for your temperament, you will betray it under pressure. That is not the theme's fault. It is a sizing mistake. A reserve outside the market also helps, because people who are liquid do not feel forced to raid good positions during stress. Again, this is not glamorous advice. It is real advice. Real advice usually sounds less exciting than the headline. That is fine. I am not trying to entertain the portfolio. I am trying to make it durable. Durability is what allows asymmetry to be harvested. Without durability, conviction turns into a slogan you repeat right before selling low. I have seen that too often. And let me say one more thing about broad market funds before I close this argument. I do not want anyone thinking that because I see a possibly unusual opportunity in technology, AI, semiconductors, and related infrastructure, I suddenly disrespect the broad index. I do not. The broad index remains the backbone. If a person owns the SP 500 or a total U.S. market fund, he already owns many of the leaders that are driving the present market. That matters. It means even the simple investor is not excluded from the regime. The question is whether this period deserves additional emphasis. I think it may. That is different from saying everything else stops mattering. And that is exactly the sort of nuance the public likes to crush. The public prefers extremes: all in, all out, bubble, no bubble. Safe, dangerous. I have never found that style of thinking profitable. The truth is usually more layered. A sound portfolio can have a simple broad market base and still make an intelligent satellite bet on the most important economic forces of the next cycle. That is not recklessness. That is capital allocation. In the end, what I believe is very simple. The next decade may still produce handsome returns for patient investors, but the most dramatic upside may belong to those who understand that public market wealth windows do not stay wide open forever. In the same form, they cluster around transitions. They cluster around disbelief. They cluster around the early public monetization of major economic shifts. And then once everyone agrees, they become narrower and more ordinary. That is the nature of it. So when I hear a phrase like last big wealth opportunity for a decade or longer, I do not hear panic. I hear a challenge. Can you recognize a cluster before it becomes consensus? Can you build exposure before the crowd feels emotionally safe? Can you stay disciplined enough to own through the volatility that will almost certainly accompany the thesis? Can you distinguish between broad foundations and concentrated upside without becoming foolish? Can you let assets do their work before your need for clarity interrupts them? Those are the right questions. I do not know what the market will do next month. Anyone honest will admit the same. I do not know which exact week sentiment will flip, which headline will scare people, which policy move will accelerate or delay the process, or which short-term correction will convince the late crowd that they were wise to wait. That is all noise around a much larger point. The larger point is that several forces with real economic weight appear to be gathering in the same place at the same time. And that sort of clustering is rare. Rare things deserve attention. Rare things deserve capital. Rare things deserve patience. And they especially deserve action before the crowd receives emotional permission. That is how the really large outcomes happen. Not in comfort, not in perfect clarity, not in the last chapter. When all the charts are clean and the media speaks with one voice, they happen in the middle of doubt, when the future is visible but not yet universally believed. That is where I think we may be standing. Now, if I am right, then 10 years from now, the most important decisions will not be the dramatic trades people bragged about in real time. They will be the simple, sane allocations people made while everyone else was still busy deciding whether the opportunity was real enough to deserve serious money. That is what I would want to get right. Broad ownership first, layered conviction. Second, patience always. And enough humility to understand that the market's greatest gifts are usually handed out before the crowd calls them gifts. That is when I like to be there. That is when I think the odds are best. And that is why I believe this period may matter far more than it feels like it does while we are still living inside it.